All right, guys, welcome for joining us today. I'm so excited to have our managing director of Rehab Wallet on, Angela Dunn. Angela, welcome to the show.
Thank you so much. Thanks for this opportunity.
Excellent, excellent. Well, Angela, before we dive in and, helping our investors understand exactly how Rehab Wallet is mitigating risk in today's environment, but also like how they're navigating the default process with confidence, right? As we move forward through this environment, before we like tap into that, would you take a moment and just let everybody know who Angela is, how you got into debt fund management, and where we are at today?
Okay. Well, thank you. Well, my name's Angela Dunn. I'm the managing director at Rehab Wallet, our debt fund at passiveinvesting.com. And my leadership career has predominantly been in retail. But for the past 3.5 years, one of Kelly Garrett, which is one of our founding partners at Rehab Wallet, I have been a teammate and a friend of hers for more than a few decades. We've actually known each other for 41 years. We've been basketball teammates since we were teenagers, and now we're teammates in business. And it's been incredibly rewarding, a little challenging at times. We actually launched the debt fund and started Rehab Wallet in June of 2020. And most of you guys, even though we would like to put it further back in our memory, that was the first year of the pandemic. So have learned a whole lot since then. Certainly could not have gotten where we are without our amazing partners in the capital raise team and our education team, yourself, Whitney. So that's just a little bit about me and how I came to be a part of Rehab Wallet. It's basically as the COO for Kelly Garrett and all of her businesses, with Rehab Wallet and the debt fund by far being the primary, most fulfilling one.
See, there I go again. I had my mute button on. There you go. Okay.
Okay. All right.
Mute off. Well, thank you so much for sharing that. And let's where is Rehab Wallet at today, right? Like, we started off, a few months ago, we checked in and we were at 223 million loans, uh, made 1,150 individual loans. Where are we at today?
Awesome. Well, Whitney, our day wouldn't be complete if A, I didn't get to share, or B, somebody didn't have to listen to me brag about our team. So as of a week ago Thursday, we actually hit $250 million in loans funded. So we're now right at the 252 million or so dollars in loans funded. And we're also we're just approaching, probably maybe as early as the end of business today. We will have funded 1,260 loans. So it's been incredibly rewarding. As I've said, it's been really busy at times, but for the most part, after 3.5 years, our team has settled in. There's a nice cadence and rhythm of balancing the ever increasing demand that we have for our product. And it's a great position to be in. And I can't underline and emphasize that enough. It's amazing to be a part of an organization and to provide a service where demand exceeds supply. And so, $250 million as of a week ago Thursday since inception, and 1,260 plus loans next year. 450 plus additional loans easy that will, and I say easy, I mean, that doesn't mean there's a magic wand or anything, but uh, conservatively is our goal for next year. All
Mm.
right. What you got for me, Whitney?
Well, and I just wanted to pull out before we dive into today's topic that, a lot of people, and I talk to investors all the time, they're curious. They're like, how is the lending business so booming right now when, banks aren't lending on, lending that much on multifamily and self-storage. How is it that our business is booming? Well, you said the supply and demand has tilted, and it's tilted to the private investor's favor. So when bank money evaporates, that's an amazing opportunity for us as the private investor to step in and continue to solve that problem in the market.
That's the best way to look at it, Whitney, because twofold what you just shared, and that is the opportunity or the door that it opens for us as a lender to flippers, and even for those who don't want to update the home or the asset that they're purchasing or the property that they're purchasing and then sell it. About 20% or so of our customers, our borrowers, want to buy and hold. So after they make the improvements, then their exit strategy involves refinancing. And while over the past year and a half, that has become a little more challenging for them, this is probably a perfect segue for me to share the additional sister or brother company that Passive Investing and Rehab Wallet partnered with, and that's Consistent Capital. So Whit McCarthy and his team, as of August, have opened up business, and the reason and the void, if you will, that they're fulfilling for our borrowers, in addition to the public in this community in the Southeast that we've developed at Rehab Wallet such a great relationship with, and that's to assist them and to get them refinanced so that as they continue, they meaning our borrower, as they continue to build the portfolio, that they're able to optimize their profits and focus their attention, spend less of their time trying to shop refinance options, and instead focus on what they do best, and that's helping create and positively impact the housing shortage and create homes, whether it's in single family homes or some small multifamily, four door properties, things like that. Does that help answer the question?
Oh no, definitely, definitely. Well, I want to pivot a little bit, right? We've spent a lot of education, recently on how to underwrite note funds. We did an update last week on, just where the Rehab Wallet business stands and the direction that Rehab Wallet is heading. I really wanted to take this opportunity to kind of, answer some investor questions, right? Because a question I get often is like, we're moving into if we're not already there, 2024 can be, is penciling out to be a really interesting year. There's a little bit more squeeze on the investor, our rates continuing to go up. What would happen if we started seeing more defaults here? So first, I wanted to, kind of just start with the first question, like what is a default and why is it important for the end investor, the limited partner in the debt fund to understand what a default is?
Okay. And this question gets asked, more than once or twice. So I appreciate the opportunity, and again, this opportunity to speak directly to our investors. Rehab Wallet defines a default as a foreclosure. Specifically, if we have to take ownership through the legal process, have to take the property back. And while our business model for the first 3.5 years has been wildly successful, we've only had one foreclosure since inception. And even that one was still profitable for our investors and profitable for Rehab Wallet. But to answer your question, Rehab Wallet in the debt fund defines a default as a foreclosure where we have to take the property back and the ownership of the property.
Okay. And so let's kind of walk the investor through a little bit of a process. And I have some questions to guide the conversation. Like let's start with, first of all, the number one goal here is to actually avoid the default if at all possible. So what specific measures do we take through the debt fund, through Rehab Wallet to mitigate a potential default from the beginning?
Okay. I think I want to preface that with it goes hand in hand with the service levels, the customer service that we provide, because we don't differentiate the way that we treat a borrower who has successfully exited properties and who shows, no sign of, or very little, if ever, a sign of potential default. But we treat those and we manage that loan and we monitor that loan in the exact same way we would one that is maybe hinting at a potential default. And by that, what I mean is we keep lots of, both through the origination process and through the compliance process and the servicing process. We keep open lines of communication. We keep our fingers on the pulse so that, at least historically, what we've been able to determine is we may sense an issue even before that borrower, that flipper does, because of the quantity of loans we've seen and that our founding partner have been a part of. And then I really think our secret sauce is in the origination. Our director of sales has over 2 decades in the lending and mortgage industry. And she herself now, after 20 plus years, this is Anna Teixeira, after 20 plus years, is still an investor herself. She has properties that she's flipped. She has properties that she has in her personal portfolio. And those steps that she takes at the origination stage, the final question she asks herself is, would I want this in my own personal portfolio if the borrower was not able to successfully exit this loan? So we just monitor them as if they were our own projects, quite frankly, not to oversimplify it.
Mm. So what are some of the early warning signs that a borrower might be on shaky ground?
Okay. Well, I'll share with you just some of the first things that we look at that will indicate and put a particular loan or a borrower or an asset just on our radar. And that's if their response time, their responsiveness, both during origination, funding the loan, but especially as the loan begins to be serviced. That's really where our compliance director, who she herself has, again, probably 2.5 decades of expense management and customer service experience. So if there's maybe a little bit of unresponsiveness or delay when we're requesting for information, she may put her arms figuratively around them in a little more snug manner. And by that, what I mean is, as she begins monitoring the process and the progress of the draws, the repairs, and is looking at the scope of work and watching time pass. And in most cases, our average loan right now is 180 days or 6 months. If after 2 months they're not about 30 some percent of the way through, and based upon the conversations and communication she's then had with the borrower, if there's an indication that they may not achieve their exit strategy in a timely manner, meaning by their maturity date, then she'll start to partner with them even more closely. And that's what I mean by figuratively lock arms with them, put her arms around them so that we can put her in touch with maybe some other more experienced, or him, the borrower, more experienced borrowers and investors, flippers, that could help them work through whatever hurdle maybe they're experiencing.
Hmm. So let's name, I would love to hear all the different strategies, right? You've kind of hinted, scattered throughout the conversation that, there's system and processes in place that you guys have to kind of like flag the borrower or the asset, or just the timeline is off, right? And so I want to dig into that separately. But what are, if a default is kind of looking imminent, right? Like a property has gone on flag, so to speak. And that's my terminology, maybe not yours.
Okay.
Like what are some of the, the opportunities for exit here, or for reconciliation in a way? Like
Okay.
what's kind of the punch list here?
Well, the checklist or punch list, again, that our compliance director would use is we seek to understand the why. Why is this occurring? Because if for some reason the borrower doesn't understand why, we start asking probing, open ended questions to help the borrower and us discover why is this occurring, because it's only then that we can pull out of our toolkit what some possible solutions might be. So I'll give you an example. Let's say a borrower who met our experience levels when we were vetting, they've successfully exited, 3 or 4 or 5 flips in the past year, but maybe they haven't managed their way through a significant foundation issue. And during their due diligence and that time frame that they bought a particular asset or a property, their general contractor or whoever partnered with them during the time frame when they were making that buy decision just didn't discover the foundation issue. And here now they own a property, they're 3 months in, and this was not on their scope of work. And many of our people in the audience, certainly our average borrower, understands that when you have to add that to your scope of list, your scope of work, we're not talking about 3, 4, $5,000. You would be super fortunate if that's all that foundation issue turned out to be. So not only do we have, foundation repair and experts within our network, because again, as a reminder, our founding partner flipped properties for over 18 years, hundreds and hundreds of scenarios she's came and went through successfully. But we would then, if that's what we determine is the current hurdle that that particular borrower is now struggling with, and either A, it's going to significantly impact their scope of work. Maybe they don't have someone, they don't even know where to go to find a foundation specialist. We have those people in our network, and we would just connect them. We would just connect our borrower and nudge them. That might be the word sometimes it's used. We might nudge them in that direction, provide them a name and a phone number to call, and then a couple days later, find out how that conversation go. But um, that's while it may seem a little bit cumbersome to imagine what that looks and sounds like, that's what our compliance director does all day. She really just digs into her customer service skills and takes that borrower by the hand to get them to the finish line. But that's one example, an unexpected repair that that the borrower's contingency plan didn't account for or couldn't account for.
And I love that, because it goes back to what you said at the very beginning, that, one of the things that sets us apart and also, makes the fund unique, makes our relationship with our borrowers unique, is the level of customer service. Right. And we're not here to try to help every single borrower solve all their issues, but if there is an issue, definitely, we can, help them kind of pinpoint what it is and make those connections, whether it's to a particular vendor, or if they need to exit to another investor. I've heard you speak about that before, or even just, pulling it back together if they need to refinance out, how can we connect them with consistent capital? There's all these things that we can, as a borrower, that's within any borrower's purview, or not borrow, but lender's purview, to be able to help their borrowers do that. But I don't know of, I've flipped a fair amount of property myself. I don't know of any company that does that on a regular basis.
And we're referring to a small percent of our loans,
Mm-hmm.
but our goal is to keep it that way. And just like with performance management with any organization, if our borrowers know and are expecting us and know that we're going to hold them accountable for their performance and achieving their exit strategy, and when you factor in that our return borrow rate, these aren't new, it's a small percent that are new borrowers. We're probably 24 months in a row now where we've averaged an 85 to 86% return borrow rate. So by far the majority of our loans are with borrowers who've known us in some cases for years and have already successfully exited multiple loans. We have a handful of our borrowers that have successfully exited now two dozen plus loans. And we think the biggest thing that prevents them from going somewhere else is that service level. When they perform, we want them to stay with us. And when their asset and the area and the market that they want to flip or buy and hold is in the market that we serve here, predominantly in the Southeast, we don't ever want to give them a reason to leave. It's a good fit.
Awesome. Awesome. All right. So, we've talked about all the different ways that we can, one, mitigate it in the beginning, underwriting, customer service, things do start kind of creeping up, ways that, we could potentially help that borrower, make a sound exit on their own. Let's get down to the nitty gritty. I remember when we were talking about including this topic in our educational mix at our board directors meeting. And the topic came up that default's not a dirty word. Our marketing director would not allow me to name that podcast that way. So anyway,
That's why she's in charge of that and we aren't.
Exactly, right? But so okay, a default happens, and right now we've just had one, but hypothetically in this market, we could expect to see a few more, right? What are the impacts here if one occurs?
Okay. Well, we've had one, and our investors had no impact whatsoever. We did experience a foreclosure in 2023, and our business model is set up so that our investors don't feel the impact. Now, that was, those particular stats are almost unheard of for you to have, or for any business, any lending business to have over 1,200 loans and to only have one foreclosure. So we do anticipate, realistically, we are planning for, and we have a plan in place, but it's not that different than what I've been describing, and it won't have any different impact on our investors. And the reason being is, I think I've heard our partners refer to it this way. In the capital stack, our investor gets their prep payment or their funds back first. So even when, for example, in our business plan, it was one default or one foreclosure in about 1,000 loans, and that number, again, it's going to increase, but our business model is built to allow for that to increase, and it could, while this is not in our business plan, for it to allow for it to increase up to what the business model would account for, meaning almost 50% of our loans could default before the investors' funds would be at risk. But
I just want to insert real here. If anybody hasn't done the math with me already, 1 out of 1,260, that is, I'm trying to read here the number of zeros. It's 0.079%.
it's exactly.
That's
So,
amazing.
and that's the actual result as of today's date. That's the default ratio. And our goal is to have less than a half of 1%. So even when it increases, and we do again anticipate that occurring in 2024, the plan is still so much lower than what the industry and other hard money lenders and other debt funds have experienced. But the line that we can draw is, but they also don't experience an 86% return borrower rate. So we know that's critical to our success. It's also intuitive and built into our culture, and that hasn't wavered. It's been to low 80s to the low 90s for 24 months in a row. And we don't, there's not anything that we would allow for that service level to drop. But we also don't have our heads in the sand. We know that there's going to be some more. And the most successful way that we have mitigated defaults in the past, I shared with you kind of how we did have one. And if a rehab, let's say the borrower discovered that foundation issue and now their scope of work is out of whack and they got to revisit it. But in most cases, when we sense that a borrower is either already started to struggle or we see that on the horizon, it's most often due to just life events. There's things that have occurred that happen because we're all living our lives. And now that rehab or that project or asset, it's just a little overwhelming for them. And they'd rather not have to deal with that because maybe there's something a higher priority in their family or in their personal life or their health, or just, again, life happens. Then we partner that borrower who currently owns the asset that's maybe just overwhelming or overflowing on their plate now with another borrower whose plate isn't full and is just looking for deals. And we just connect those two, and the the borrower who's struggling and whose plate is too full then sells it, pays us off, and now there's a new borrower who has the bandwidth, who has the energy, who has the resources to get it to the finish line and achieve the profit plan that they had in place. That's what most frequently occurs to mitigate the impact to the bottom line.
I love the fact that there's just so many, if you want to call it, tools in the tool belt here that can be used to really, one, provide amazing customer service to the borrower, right? And that's how Rehab Wallet got that repeat borrower rate, right? The amazing customer service. But two, continue to create, maintain a win-win scenario, right? Because I know our mission, vision, values aren't about, hey, let's wait for the borrower to default so we can take back the property and make 40K on the property. No, that's not it, right? We're trying to, what I'm picking up here is, what rehab is doing is really, mitigating the scenarios, situation as much as possible, protecting investor capital, as much as possible, but also trying to create a win-win with borrowers and investors. So I love that.
And I appreciate the way that you recap that and kind of brought it all home, because without putting it on our website, that is really what can occur and what is built into our culture and our business model, because that then maintains an alignment of what's in our investors' best interest, what's in our team's best interest, and what's in our borrower's best interest, because all three of us can win in this. And we have been winning and have been successful, and there's not any reason, as long as we pay attention and we stay focused, and each person plays their role, and we just keep our heads up.
Awesome. Well, Angela, thank you so much for your time today. I want to transition us into our Ask Me Anything session here in a second. But as we wrap up our live portion, what do you want listeners here to take away? What is the one thing that you want them to take away from today?
I think if I could just deliver it in one line, it would say our team's going to be good ambassadors of your investments. And we do that by keeping the best interests of our investors, our team, and our borrowers at heart. We feel strongly about that.
Awesome. Well, Angela, again, thank you so much for joining us live here today. If anybody wanted to reach out to you, how could they do so?
Angela at rehabwallet.com, please.
Awesome.